Let's get started, everyone. Good morning and welcome. Welcome to ComplyPort's webinar, KYC Challenges and Best Practices, an incredibly important topic domestically, internationally, and the focus for the FCA for the past couple of years and still ongoing for 2024. My name is Alla Konakov. I'm one of the managing directors here at ComplyPort and in charge of the client experience, both onboarding, business development, and any issues that come up with our clients. I will be your moderator for today, and I'm joined by two of my esteemed colleagues, Paul Granger and Nicola Christofidis. Paul is the chairman of ComplyPort and brings over 30 years of regulatory experience in governance, risk, and compliance. Paul's experience includes work with lots of different types of clients, regulated, not regulated, international, national, managing a lot of different issues, problems that are not textbook-based. Nicola brings over 18 experience specializing in banking, governance, and particularly financial crime, with numerous experience at the FCA. I will briefly run through the agenda before I hand over to my colleagues. This morning, we will discuss the what, the how, and what does this mean for you? So what is, very briefly, KYC, and what is FCA's focus in 2024? How do you and other firms effectively, seamlessly, and accurately comply with the KYC regulation and KYC processes? And some case studies, some tips, and some takeaways of what it means and what perhaps you should be doing. So KYC, or Know Your Customer, is a set of processes that allow banks, financial institutions, and other companies to confirm the identity of individuals and companies that they are engaged with, primarily to prevent them from money laundering, terrorist financing, or any other kinds of corruption. This market, the KYC market, is evolving and fragmenting, and nowadays even driving business decisions. Firms are getting better at this, better at the seamless and accurate customer experience and meeting the regulator's expectations. Bearing in mind that regulation and the regulators have become much more sophisticated, much more technical, much more exacting in terms of what needs to be done and when it needs to be done. Disruptions in the landscape have meant changes. The pandemic has shifted and changed this onboarding process. The fintech ecosystem has introduced new forms of payments, new forms of digital capabilities. And this has meant that the industry can no longer stay static. It has to be dynamic, not just reactive. It has to be proactive. And of course, we can't forget or neglect the sophistication and proliferation of the financial crime, particularly around the increase in the connections between financial organizations, the corporates, causing costly crime management, AML, KYC processes that have had to adapt, have had to become more dynamic and sophisticated. So in light of this, can I ask you, Paul, to tell us what does KYC or Know Your Customer actually entail?
Certainly. Thank you, Ella, and good morning, everybody. I hope we can get into the weeds of this quite quickly. What is KYC? It's a requirement under the regulations in summary. So the Money Laundering Regulations 2017, which are the regulations that currently, shall we say, frame part, but not the complete picture, are the key driver. So KYC itself is really what it says on the tin. It's about knowing your customer, sometimes referred to as client due diligence. And there are different forms of due diligence. But what do we know about the person who we're proposing to enter into a business relationship with? or indeed have an existing business relationship with in some cases. First part of know your customer is obviously identity. Who is the person? What do we know about them? What do we know about what they want to do? And that's a key part of assessing, shall we say, the risk of the relationship. So what potentially could go wrong in this relationship from a financial crime related perspective? And it doesn't just apply to the, shall we say, the superficial customer relationship, but we need to know what's behind it. Who's the beneficial owner of any benefits arising from the relationship? What's the legal structure of the relationship? What are the entities involved, and what do we know about them? What can we find out? There are a number of risk factors that we need to consider. For example, what do we know about the background of the person other than what that person or that entity has actually told us? So a little bit of, shall we say, digging, ranging from things as simple as perhaps just a quick check on some search engines, Google and others are available too. What do we know about the person? What's out there in the domain? What can we find? Is there anything adverse, which is really what we're looking for? What we call adverse media attention. Is the person a PEP, a politically exposed person? Are they in a position of political influence, or are they close to people of political influence? Spouses and partners being the obvious example, but it could be other relationships too. And effectively, what risks perhaps are posed by things like the source of funds? Do we know where the money's coming from? Because in any financial service, there is normally a monetary transaction involved. We need to know the source of funds. And we also need to think about significant things like, are there any sort of chains of logic in the evidence we know that don't make sense? And if so, can we explore them without, of course, the risk of perhaps tipping off if we have suspicions that something may not be absolutely, shall we say, as it should be? I think it's important generally to think about what constitutes ID, and there are multiple sources. The most obvious is that generally any identity document containing a photograph of the person that enables us to match that photograph with preferably a physical meeting with the person is always helpful. And these are generally going to be government issued documents, or documents issued perhaps by government agencies. For example, the Armed Forces ID card or similar, or think of a driver's license. But they can be also cross-checked and verified in terms of things like address or addresses, if addresses have a short stay against them. And again, these can be verified by documents issued perhaps by other financial institutions that are obliged to comply with the money laundering requirements, such as a bank or a credit card issuer. So statements addressed to the person's current residence, preferably, address ID that's perhaps within 3 months old or similar. And then the secondary part of KYC is the continuing monitoring obligation. And I just encourage you to consider continuing monitoring in terms of the acronym SAT. Status. Has status changed? Is activity okay? And in terms of transactions, is there anything in terms of transactions that sticks out as being unusual? Final comment from me on this, with the rise of, shall we say, new technology enabling things like mobile apps, biometric data, and so on to be introduced, that can actually make the verification of ID in some senses easier, but be alive to the fact that just as we can use that kind of tech, so can people who are seriously involved in money laundering or financial crime. So again, be alert, shall we say, to the potential for those kind of issues to be misused. A very quick reference here on the slide to the scale of money laundering and financial crime. I'm not going to read through the figures, you can read them at your leisure, but suffice to say that financial crime is growing. And remember that wherever there's a financial crime, the definition of money laundering is the introduction of dirty money or the proceeds of crime into the legitimate financial system. financial crime is on the rise, and therefore money laundering is on the rise. So, this is a problem that's not going away. It's only going to grow.
Thank you very much, Paul. Nicola, why is financial crime, KYC, AML, such a focus for FCA and continues to be a focus for FCA today? You're on mute. Thanks. There you go.
Thank you. Thank you, Ella, and good morning, everybody. In recent years, the regulatory resolve in this space for AML sanctions related to fines and penalties imposed has surpassed 200 million. And you saw from the before slide that Paul spoke to, the fines are just going on the up year by year. And the regulators' focus over the last couple of years, it's increased exponentially. You'll see on the slide why it's a high regulatory priority. I'm not going to go for individual points in the roadmap, but you can see it's because primarily financial crime, as Paul said, is on the rise. Consumer detriment is getting higher and higher. And it's not just financial firms that financial crime is impacting. It's those that are also regulated by HMRC, such as accountants and law firms. And the landscape is changing constantly. A recent change in the regulatory landscape on the 10th of January this year was PEPs, politically exposed persons. And those that are now overseas PEPs and UK domestic PEPs, the ones that are domestic are going to be subject to enhanced due diligence. And so with the new regulations constantly changing, it's really important to be on top of it for your firm and to know what's going on in the regulatory landscape. If we move to the next slide, you'll see the FCA priorities for 2024. And this includes preventing serious harm to consumers and securing an appropriate degree of protection for consumers. And how do they do this? By reducing financial crime. The FCA wants firms to really take on board the increase in financial crime and to really look at their practices in KYC. And how are they going to do this? How are they going to be on top of firms? They're going to use enhanced data, enhanced intelligence. They're going to funnel resources to the teams that are going to look at KYC best practices in firms. And they're really going to use a lot more resource to look at firms now. It's really a priority in the business plan for the year ahead. And I can't stress that enough. And they're going to be looking at, have you got adequate controls? Have you got adequate processes? You might have been using the same processes for a number of years. If so, this is the time to look at them. This is the time to revisit them and give them, a freshen up and to improve them. So they are going to be best practice, because the regulator is going to be looking to see if there's gaps. Have you got any gaps in your processes? Excuse me. And the FCA continues to work with the Treasury and other regulators globally. So one thing I want to stress to you all is that we do not, as firms, just need to be worried about the FCA as a regulator. We need to be worried about the global regulators, or at least have it in our mind that the FCA are not the only regulators that are going to come down on us. If you have a financial crime issue that involves another territory, for example, in America, excuse me, you might have the SEC or the New York Fed. You will not just have the FCA, you will also have them as well. So what does that mean for your firm? What does it mean for you? That's something that you really need to take away and think about, because, from working at the regulator, I know that they talk to globally, they have weekly meetings about firms, and I know it's going to get higher and higher. So what does it mean? Is your firm, could it be subject to global regulation as well as the FCA? So it's something to think about and take away.
Thank you very much, Nicola. So having mentioned that Know Your Customer, or KYC, is the process of verifying the identity and the legitimacy of your clients, your customers, whether individuals or corporates, before providing any kind of service to them, primarily to combat this rise in illegitimate or criminal activities. So this KYC, or this onboarding process, is the first start of the client journey. This is the door that we open, and sometimes we close that door. Sometimes it is the showstopper. And that's why it's vital to open the door correctly and keep revisiting or monitoring or checking in whether we correctly let in that client or that customer. So Nicola, how do firms undertake the KYC process? What are some of the do's and don'ts?
So you'll see on the screen, and I'm sure many of you have gone through the KY practices, and you'll see the various personal information you go through, identification, business information, biometric data, the simple enhanced, excuse me, the simple and standard enhanced due diligence that you do as a firm. Now, why do you do this? You do not just do it as a tick box exercise. You need to get that out of your head. It's not why we do that. Okay. You do that for proper due diligence. So you know your customer base, you know the risks that are involved, you know who have you got in your firm, who are your customers. This is why you do it. And the customer due diligence is so important because it's something that you as a firm will get to know your customer base, as I just said, and you demonstrate to the regulators that you know your customer base. So you'll see on the screen, and I'm sure many of you are aware of the different 3 pillars here. So I'm not going to labour on any of these points with you because it's self-explanatory. However, it does link into the next slide, which is something that we need to focus on and something that I think we really need to raise awareness of. So when you're doing the due diligence, you will, your customer will go through and you'll have checks, say we've gone through the standard process. And so when it goes through the standard process, you need to ask yourself, is your customer deemed as low risk? What is its risk profile? Is it low risk, medium risk, high risk? One thing I need to say is that with KYC, your customer's risk base can change rapidly. It can change, when the change of address, it could have, Paul's mentioned adverse media attention, something could happen which changes that risk profile. Now, if you're not monitoring your customers, you will not know that the profile of that customer has changed. And it's so important because I think sometimes firms, they will do the checks and that customer will sit there for maybe a year, no ongoing monitoring will happen. What are you doing to check back to those customers? Are you going to have it on standing agendas of your risk committees? Is it standard agendas of your board meetings? What are you doing as a firm to actually look at the risk profiles and ongoing monitoring of your KYC client base? I think that the regulators now going forward in their business plan are going to want firms to really up their regular monitoring of the customer base. I think now is the time to really look at your processes of how you're going to monitor it and what does that look like for you as a firm. I know that you might have finite resources. I know, some firms, there's big firms, there's small firms, but you really need to look at this and discuss it with your risk, your board members, and how is this going to go forward? I think that something that we all need to really be aware of and to take into account is the joining up of dots. So when you're monitoring those individuals, the first line and the second line, the dots the dots are all joined up together. Is there something that you're missing? Is there something that's not being filled out? Does it need to go to the next stage in the 3 pillars of customer due diligence? All of these questions should be going around in your head when you're actually looking at your customer base and doing the monitoring as a firm. The takeaway that I would say here is that you do not want your low risk customer to crystallize, the risk to crystallize turn into a high risk, and you knew nothing about it. That's the one thing I would say, is that the monitoring of your customer base will ensure this does not happen. And I think the regulators are going to be looking at this and going to be looking at your processes of how you'll make sure that those risks do not crystallize. Thank you, Ella.
Thank you very much, Nicola, very helpful. Paul, are firms getting this right? Are they doing what they should be doing?
That's a very good question.
And what are the challenges to what they're doing, or what are the perceived challenges and actual challenges?
Let me take that first. Our firm's doing it right. The only accurate answer to that is you'll only ever know if you're doing it right if you don't get into difficulties with a regulator or with law enforcement. So that's the scale of the shall we say, the measure that we have to meet. Generally, I think most firms would attempt to do things right, but very often there are gaps in their methodology. And one of the most obvious ones is sometimes the simple step of making sure that the procedures, policies, processes, and so on that firms use are actually matching the risks that the firm has identified it faces, or indeed, the firm may not even have identified the risks it thinks it faces. So risk is at the core of this. What is the risk in terms of the client's status, the source of funds, the nature of the transactions or the activities that the client wants to carry out? And do we have, as the firm that has to police the system and identify the client and make sure that the regulations are observed, do we have the appropriate resource, expertise? And that resource, by the way, is a combination of both people and other monetary or additional support that may be required to make sure that we can actually implement the regulations properly and thoroughly. Some firms would do everything in-house, and that's fine if those firms have the expertise, the competency, the resource to do so. There's always the challenge, though, of making sure that that resource is appropriate to meet the scale of the transactions and the clients that the firm is dealing with. It may be also that firms use software to help with that process, because one of the difficulties is, again, the efficiency with which that can be done. Now, again, software tools, there are many available, including Map FinTech, our sister company, and tools can be very useful, but don't use tools just for the sake of using a tool. The important thing is what that tool can do to help you make your process more effective and more efficient. Some firms would also utilize external resource, whether that's in terms of getting guidance, perhaps from firms like ComplyPort, maybe getting legal input where required, or maybe even looking to outsource parts of the resource required, or basically to insource, to bring in additional resource, perhaps on a temporary basis to cover peaks in workflow, or whatever it may be. But the key thing throughout this is to make sure that the resources, the policy, the processes clearly match the risks that you've identified that the business faces. And why do I say that? Because that's exactly the methodology that any of the key regulators will use, whether it's the FCA, whether it's a professional body, or whether it's HMRC or any of the other regulatory bodies. One final key point here, and this relates to the challenges that we face, is maintaining a degree, an adequate degree, to be absolutely correct, of competence. If we've identified that financial crime is growing, as I alluded to earlier, and if we've identified also that technology will evolve and will be used by criminals to facilitate money laundering, then we have to stay smart and we have to be trained, equipped, and experienced in terms of what are the things that we may face now, but what are we likely to face going forward? Are we equipped? Are we aware enough of what those things may be that we can put those lines of defense in place through both the KYC, CDD processes, but also in terms of what our technology and so on is capable of delivering? And one of the key things, for example, in using technology is understanding what it actually does and what it can do, and how that can be used as part of the process. One of the things that emerged during and post-pandemic has been an enormous rise, for example, in just ordinary consumer fraud and business-to-business fraud. And this is a major challenge, because the proceeds of fraud are the proceeds of crime. And we're going to face challenges of those proceeds trying to be introduced to the financial system. We've also got issues around things like now less dependency on cash, but the use of what we might call plastic money. In other words, cards and various other means of credit transfer. We've also got the growth in AI-driven fraud, AI-driven transactions, whether that's push payment type transaction fraud, or whether it's more sophisticated. And that's without going into areas like the dark web and all the other plethora of, shall we say, devious activity that's out there. So effectively, we need to be aware too that regulators will change. The regulations themselves will change. Regulators that may combine resources, that they may reorganize the way that regulatory supervision is carried out, and so on. And indeed, some of these changes are coming down the pipeline now here in the UK, and also at international level. Recognise, as Nicola alluded to, that regulators already cooperate, but that cooperation is going to increase. Data will be shared, intelligence will be shared, and we can expect a much more joined up approach on the regulatory front and on a cross-border basis to try and combat financial crime. Indeed, I've been involved in a couple of investigations where precisely that has been involved. It's been multi-jurisdictional and it's been multi-agency based. And I think above all, the challenge is to make sure that we don't assume we're just getting it right and that we fail to go back and constantly reassess the risks that we face and constantly reassess whether our policies, processes, procedures, and resources are adequate to meet those evolving and changing challenges and risks as they develop.
So, Paul, given the changing landscape, really, and the rise of the sophistication of the crime, the expectation of the regulators, if a firm wants to scale up their current, let's say, effective KYC framework or processes, what are the key takeaways for them? How do they best think about the scaling up if they're growing, if they're expanding, if they're changing?
A couple of principles that are important to bear in mind in any attempt to scale up is that there will always be a resource limitation. There are still only 24 hours in the day, and very few of us can actually work 24. Most of us will go into a fatigue decline at around about the 10 hours mark a day. So we can't expect people to work round the clock. We're not automatons. Nor can we expect technology to really replace the input of people. Technology can help people, but the key challenge will always be there. Shall we say, we're scaling up by adding in people as a resource, because even to operate the technology properly, we still need people to operate the technology. But it's also recognizing where roles and functions arise. The first line of defense is the business line. The second line of defense is the anti-money laundering function. And from that perspective, it's making sure that in the business line, there's the appropriate training, there is the appropriate competence and the appropriate understanding of the challenges and the object of the anti-money laundering function actually existing. It's also important to make sure that information is not siloed. It's within reason shared openly and is commonly available. There may be some restrictions on that, especially around risks of potentially tipping off, but that's hopefully relatively rare and infrequent, and can then be contained as it arises. But the important thing is to make sure that business lines, that departments, that operations in different territories even don't operate as silos, that information and intelligence is shared, and that the risks are seen in the round. The analogy I would give is that any attempt to scale up is always a bit like a cube. There's more than one facet to consider, and to make sure that information and that functionality is shared.
Okay, thank you, Paul. So we're looking at moving away from silo teams or non-sharing of information, ensuring that the technology we invest in or have to invest in does what it needs to do. So whether we're reducing the labor or using the labor smartly to make sure we have the competence experience with the technology to make sure that the investigative process and the sophistication of what we need to do is adequate and seamless. Thank you, that's helpful. Before we move on to part 3, where I ask you to share some of your personal hands-on kind of war stories or experience, I do want to make sure that my participants know that the slides will be shared, the recording will be shared. Questions you may have, and I see them coming in already, please do pop them in the chat box, and we will get to them as many as possible today, but all of your questions or concerns will be answered by email after the webinar by our team. So looking at part 3 now. Nicola, what is an example or your personal experience with either onboarding or AML or KYC processes that you would like to share with us today?
Thanks, Ala. So I touched on PEPs, and many enhanced due diligence reports concern PEPs. And I've seen numerous examples where the subject of the report is not disclosed that he or she is a PEP. I'm sure many of you have too. And sometimes the subject has really deliberately not shared information, makes no mention of political or government appointments, you know. And I was in a firm, and this particular individual was a PEP in Russia. But he described his business activities as owning huge, large cattle fields, and you know, acres and acres and acres, and which was very true. He did, and considered relatively low risk. However, something wasn't quite right. He had a passport that he gave that wasn't Russian. It was another, and he started, you know, we started doing some more digging, and straight away, as Paul mentioned, you know, Google is a wonderful machine, and threw up lots of adverse media attention. Also, there was widespread allegations about this individual, corrupt, part of enforcement investigation, police investigations. I mean, you know, we would never have known on initial, you know, on the initial checks, even though that, you know, we did the enhanced due diligence. And it's not uncommon sometimes for a corrupt PEP to have lots of different passports. So they may provide you with a passport, and then they will have several other passports as well. And in this stage of, you know, biometric data, they can actually intercept that as well. You know, they're very, very clever. So it's really, they obscure their sort of where they're actually from, where their origin is. And it's really important that, you know, in these situations, as I alluded to before, the enhanced monitoring of these individuals, when you can see the activities will slowly change over a course of time, because they can't hide, you know, they can't hide forever. He can't be a cattle field owner and then lots of other, you know, things that we find out that in the media, etc., that we actually know about. So it's and I'm sure, you know, many of you have come across situations like this, and it's just being, you know, competent in our jobs and joining the dots, and doing that continuous monitoring that we have alluded to ensure that, you know, these stories that we are now providing hopefully don't crystallize for the firms that are on the call.
Thank you very, very much. Hopefully not, Nicola. Paul, just briefly, because I know you have vast experience nationally and internationally, global firms. What are some KYC war stories or things you've been involved with that you can share with us?
I'll give a couple of examples, but I think what I want to try and illustrate with both of these examples is real life doesn't actually come up in the form of a textbook case study. It's usually a bit of a curveball scenario. And so you have to think on your feet. You know, it's non-standard, that there's very often no ready reference point to go to. And it's a question of going back to the sources and seeing, well, what do I need to do in these circumstances? I mean, above all, you can't freeze in the headlights. You can't just do nothing. You've got to act. One particular instance was a very large investment fund here in the UK that had a prospective investor from New Zealand. The only problem was that prospective investor didn't actually meet the requirements of what we would call any normally constituted investment fund. It effectively, to all intents and purposes, in documentary terms, barely existed. It was actually rooted in a treaty between the UK government, or the Crown actually, between Queen Victoria and the New Zealand people. It was unwritten in tribal law. And whilst it had existed for many decades, there was very little conventional documentation that we could rely on. We had to think on our feet. Effectively, we determined what the regulations required, which was verification of identity in some way, shape or form. And we managed from a number of sources to get third-party corroboration that whilst there was no constitutional document or founding document or anything similar we could point to, that we were able to verify that it's actually known inadvertently, if you like, or bizarrely as an incorporation, but that this entity did exist, it was recognized, and we were able to call in a number of reputable sources, not least banks and parts of the New Zealand government, to confirm that. It was a laborious exercise, it was time consuming, but it was worth doing. Because there would have been many prospective firms, let's say, who may have walked away from that in complete sort of, well, let's say having been completely bamboozled by the circumstances. But that kind of perseverance does actually pay dividends. Perhaps more similar to Nicola's example. On another occasion, I was doing some work with an international banking group, and they had a number of client account structures. So a core account based in Switzerland and satellite accounts in other territories. And I happened to have one flagged to me by colleagues in the bank that said, we have some concerns about this account. It belongs to a notorious character associated with a South American military dictatorship, who subsequently was deceased in suspicious circumstances. And not to put too fine a point on it, the account and accounts attached to it were inherited by the spouse. The concern was the account operated exactly after death as it had operated before death, which did raise the very real possibility, given the circumstances of death, that the death was faked and that the person still remained alive and up to the nasty practices that he'd been accused of prior to death. It was a pretty easy decision to look through all the evidence and conclude, basically, we have suspicious activity here, and this needs to be raised with the law enforcement agencies concerned in the different jurisdictions, and that's subsequently what happened. But these are the kind of things that you don't get in textbooks. And one very quick example I'll close on. You know, in the last number of weeks, we as a firm have come across a scenario with a client where we've actually encountered suspicious activity with the added twist, just to make it really interesting, that the person we ought to raise and escalate this to is the Money Laundering Reporting Officer. But unfortunately, we have some suspicions that the Money Laundering Reporting Officer could be colluding in the suspicious activity. So that, again, caused us to go away and scratch our heads and look at the regulations in detail. We did come up with a fairly elegant solution to that one, which was copying the regulator as well as the relevant person in terms of escalating, and that satisfied our requirements, basically, to keep the regulator in the loop whilst at the same time fulfilling our obligations to the person concerned. But as I said, these are non-textbook examples, and you have to be prepared to deal with the non-standard, to think on your feet, and above all, remember, you can't freeze in the headlights. As a money laundering reporting officer or a money laundering professional, you've got to deal with what circumstances throw at you, and if in doubt, refer back to the regulations, or if necessary, get help from external legal advice or external money laundering advice from firms like ComplyPort where required.
Thank you very much, Nicola and Paul. So, given this change and continuous change, the new regulation, the new focus by the international regulators, as well as the continued focus by the FCA, and the sophistication required given the digital transactions or the change in transactions, KYC has to be much more dynamic, given it is part of the first line, not just the second line of defense and the decision-making process. Whether you're the decision maker in that sphere, or you're part of the board, or you're an advisor, you cannot be complacent. You cannot say we have something. or we're not regulated, or we know we do this every year, one of the questions that came up in the Q&A, or every 5 years or every 2 years. What does that mean in terms of the business you do, in terms of the risk assessment and the risk appetite that you have? You cannot onboard something or have a process that's static. It has to be ever-changing, revisited, and reanalyzed. You need to look at your business and identify what is it that you do, what are your risks, and what have you done about it? Do you have a tick box approach? Have you updated your policies but haven't actually understood how to implement them, how to train your staff? Do you have a buy-in from your board or from the senior managers who are acting together with you? Let's say you are the compliance officer or the MLRO, to implement the changed regulation or the KYC processes or the enhanced due diligence? Can you evidence the procedures, the policies, the plans are up to date, are adequate, and those who need to know are informed? And if you can't, what do you do about it? Who do you talk to? Do you get that legal advice or external advice? Do you pick up the phone? Do you attend a webinar and thereafter do nothing, or thereafter do something? So these are some of the takeaways to tell you that you can't just sit where you have always been sitting. You can't be complacent, given the individual fines and sanctions and focus, as well as the fines, sanctions, reprimands to your firm or the industry itself. Thank you very much for listening. I'm very conscious of the time, and I want to make sure that we leave some time for your questions. We've got quite a few already in the chat box. So I'm just going to have a look and just choose some of them to our panelists to see if we can get at least a little bit of a dialogue going. And anything that's not directly addressed, rest assured that it will be thereafter. So looking at one of the questions, with the budget constraints that we have, how do I get the best output, I'm assuming for your firm, to ensure sound KYC processes? Okay, good question. Nicola, can you help with this? If there's budget constraints, how do I, and I guess their firm, get the best output to ensure sound KYC processes? You're on mute.
Thanks, Salah. Sorry about that. Yes, so I'm going to answer this question really honestly with you. You cannot be cutting corners. You cannot be doing tick box exercises that we discussed earlier in the presentation. That is no longer going to suffice for the regulator. You really, really have to look at your KYC processes, and you have to make sure they're fit for purpose. Budget constraints, it's not going to wash with the regulator. If you have budget constraints and you can't look at your KYC process and do that ongoing monitoring, whether it's biannually, like Alice said, depending on your risk profiles, you have to be able to do it. And, if you don't, you're going to get fines, you're going to get penalties. Section 166 is going to be invoked. It's going to, the FCA are really, really coming down on firms, and we've seen it, constantly, especially ramp up over the last year, and it's even going to get, more the year to come. What I would say to you is that, are you doing the continuous monitoring? If you're not, you need to look at your processes. You need to make sure your board members are involved. You need to make sure they're aware of this. They're the ones who are going to be carrying, the responsibility as well as yourself. Are your senior leadership aware? Have you got it as standing items on the agendas? Have you got risk committees? Is there standing risk meetings that you have? Do you discuss it? What are you doing? Have you done any gap analyses recently? Answer, probably majority, probably not. Many firms contact us to do gap analysis of their KYC processes. It's something that we can do. It's, the one-off advice is, to help you. Smaller firms that do have that budget constraints, use your budget wisely, but you need to be, pushing the direction of, really focusing. And I think it's, it's really, really important that you don't just look at this as a tick box exercise and something that will go away and it will be static, as you said, Ella, because it won't.
As a follow-up, Nicola, just to continue with that, there's quite a few questions that are asking what monitoring actually means. How often should firms do this KYC feedback checking? Is it per transaction? Is it depending on the firm every 2 years, every 5 years? Can you help with some kind of a guidance? Because that's quite hard to keep saying, well, you need to revisit. But what does that mean for individual clients?
Okay, yeah, that's a good question. So, you need to look at your customer base and your risk base. So, you need to look to see whether are you doing the enhanced due diligence? If so, the ongoing monitoring should obviously be more frequent. Whether I'm not saying it should be weekly, but is there someone who's really high risk, monthly, possibly? Things can change within a week. Like I said before, I've seen it happen within a week. Someone could be verified, and then the next week they, all of a sudden they become high risk. I think that, those that are low risk, biannually, with every transaction, but is that transaction high risk? What is the transaction? If it is a low risk transaction, is it something that is regular, and it's more sort of something you've seen before in that client? Is it out of the ordinary? There's lots of different, plethora of questions that you could ask with regards in it. And it really depends on, it's like a case by case basis with each individual firm. You look at your risk profile, you look at your customer base, and then you decide about the monitoring. And it's something that, your board can help you with as well, discussing it, put a plan into place, because it's not a one size fits all. It's not. So I can give some, a flavour of advice, but it would have to be specific advice in order, to actually tailor it to each individual firm, because, like I said, it's not a one size fits all.
Thank you. I think that's good. Another question, Paul. Somebody's asking, how do they know that the software they're using is producing accurate results? So I'm not quite sure if this is external, third-party software, internal software, whatever it is, they're using a software for KYC. How do they know, or should know, that it's up to date probably and producing accurate results?
But there are a couple of things that can be done to let's say give more confidence about the accuracy of software tools. One of them is to understand what the tool claims to do and how it claims to do it. And this is a question of thinking, right, what am I going to use or want to use this software to do? Can it do what I want it to do? And if it allegedly can, then the vendor or the supplier, that manufacturer, should be able to explain to me in layman's terms exactly how that is done. So, for example, is it drawing on government databases? Is it drawing on commercial databases? If so, which ones? And what access permissions do they have? How accurate is the data? How often is it refreshed? Because it might be that they are drawing upon those sources, but the data's only refreshed on a monthly, quarterly, or 6-monthly basis. In which case, how current is it? Will it be current at the point I need to use it? Also, looking at issues around, for example, can it be used to do different layers of monitoring for different cohorts of the client base? As Nicola's just alluded to, it may be, and it's highly unlikely, that there will be a one-size-fits-all monitoring requirement for clients. So in those terms, what does the software do to enable me to fulfill my obligations? I have come across instances in the past of firms buying software where they used maybe only 20% of its capability, but of course they were paying for the 80% they didn't use as well. So again, can different functions be turned on or turned off? If I'm not going to use them, do I want to pay for them? And above all else, there's also the common sense test of, can it do what I can do manually? If I can do manually what I need to do, and that is accurate and up to standard, can the software replicate that? And if it can, that's fine, but can it do it faster and better than the humans? Because if it can't, then what am I paying for? Now, this might sound a little bit sort of anti-software. I'm far from it. I'm a great believer in utilizing software tools to help and to assist where it's effective to do so. But that effectiveness really starts out by making sure that the software can do what I want it to do, and it provides what I want it to provide. Final word would be, if a vendor or a supplier can't explain exactly what you want to know, then that would also raise some questions or concerns with me personally, in the sense that, well, they ought to be able to do so. So maybe that's an early warning sign if that kind of reassurance can't be given up front.
Thank you very much. Actually, another question, if I may ask you, Paul. Somebody's just asked, is it more cost effective, I think, looking at the numbers we put up, to deal with a fine, I think either internationally maybe or not, or actually invest in such software or other KYC processes for prevention?
Okay, working on the side of the angels, as the phrase goes, I'd have to say every time, it's more cost effective to get it right. And I'll give you a couple of good reasons for that. The first one is, getting it wrong is expensive. It incurs a fine and maybe other penalties, including possibly jail time. But that's not the end of the story. Once you've blotted your record, of course, you're then under closer scrutiny. So we've seen some international examples in the banking framework where we've had what might be classified as multiple offenders. And the chances are it's not strictly true that these are multiple separate offences, as opposed to, we got caught out once and we've convinced ourselves that we've reacted to it. But actually, it's not been as effective as it should have been. It's not been as thorough as it should have been. And when the authorities come back to check again, they still find weaknesses. And now it's even worse because you've been warned once. So why haven't you implemented properly? Why is it not up to speed? So it's not just this idea of we get a one-off fine and we can absorb that from profits and still pay healthy dividends to our investors and so on and so forth. There's also reputational damage with the regulators, and they're going to look to see whether you've improved and reached or exceeded the standards required. Incidentally, there's also reputational damage with investors and with customers. So it might well be that in the case of, say, certain banks, they now have a reputation that might be a lot more tarnished in view of their investors and their customers than it otherwise would have been, and may even deter people from dealing with them. I would also just finish on a note of caution. Under the senior managers regime here in the UK, and many other jurisdictions have introduced similar regimes, there's now an element of personal responsibility. So if my shareholders want to ask me as a money laundering reporting officer to take that kind of risk of getting it wrong, with the personal accountability that now attaches to that, I'd be expecting, let's just say, a sort of Teflon coated guarantee, which of course won't exist, for me to take that kind of risk, because there's no way back. So it really is now no longer, in my view, a case that there is a business case for saying take the fine and take the pain, because we'll still make good profits. It doesn't hold up, and that's quite deliberate. That's the direction of travel from regulators, and that kind of more draconian approach to punitive action is only going to get worse, not better. So get it right, spend the money. It's a cost of being in business. If you can't afford it, you probably shouldn't be in the business in the first place.
Thank you very much. Unfortunately, we're up against the clock, so I'm going to leave the questions there. I'm going to ensure that our team replies to any questions that haven't been answered. The slides and the recording will be shared. Thank you very much, Nicola. Thank you very much, Paul, for your time,
It's a pleasure.
for your war stories, for your expertise and for your knowledge. If you have further questions, if you need any advice, we're a phone call, we're an email away. Don't be complacent. Don't do the tick box approach. be proactive in this dynamic, changing, and very, very active industry. Thank you very much for listening.